Here we go. Hey, everybody. Welcome, VetVA audience, professionals, VetVA, and our YouTube channel. Thanks for tuning into this live or catching the rewatch. What we're going to do is talk about market changes with our good friend, Hammer. Hammer J. Helmer. The cowboy hat's back.
The key of the
How
cat.
you doing, brother?
I'm good. What do I? You're making me laugh though, Nathan. That's not fair.
I know. I'm sorry. Well, hey, there's a lot to talk about. Okay. It is February 28th Feb 2022. Things have been happening internationally all over the place. Everybody's watching closely what's happened with the mortgage markets, the rates, the everything going up, down, left, and right. Um, and I will say there's a lot happening. And I've got things we could talk about, but I'm curious. Like, why don't you walk us through your standard, what you like to do? Talk about. Let's talk about the mortgage rates. Probably address how the Russian invasion of Ukraine, how that's affecting us, and where do you want to go?
All right. I am actually, as everyone sees me looking on the side, that's because I am
Yep.
trying to get this to preview mode so that it looks a little prettier for a slide. And then
No
I
worries.
will show you. So bear with me a second as I try this one more time. And all right. So here, let me do a quick screen share. That'll just keep us on track and keep everything concise for those that want to see it. So, and there we are. All right.
I'll put it up as soon as it pops. There it is.
There you go. If you don't mind, if just popping up there. So thanks everybody for your patience. Today we'll go ahead and chat about what's going on with mortgage rates. Today's February 28th, 2022. So let's just kind of do the quick, concise version. The first thing is let's recap last week. Last week, I expected some volatility because we had a holiday shortened week. And I also expected that we were going to see something happen with Russia and Ukraine. That was something that was expected to happen after the Olympics. There was talk that it could happen before the Olympics, but the writing's been on the wall that, in a geopolitical situation, no matter how many times Putin said, we're not going to do anything, everybody knew he was going to do something. So Russia did indeed, invade Ukraine last week. And that historically would have put everybody in a position where we would have seen mortgage rates greatly improve. And the reason that you see mortgage rates improve in a time of war is the actual financial uncertainty. And I hate to be the pessimist, but I'm going to be realistic here. And Wall Street doesn't care about people, they care about profits. So they don't care per se that there is an invasion, but what they do care about is what kind of effect does that invasion have? What kind of effect does this conflict, this war, whatever we're calling it, what kind of effect does it have on the global economy, the European economy, and of course the US economy? So last week we didn't see much of an effect on the economy, and a lot of that was because, again, not to get too political, but we had a very milquetoast reaction to it from Europe and the US, from the Western nations, in the form of sanctions. And we're fighting this war, if you will, economically rather than with boots on the ground. Ukraine is not a member of NATO, so they're not getting our troop support. However, we are, we did establish sanctions, and the sanctions were much less severe against Russia last week than what was expected. And therefore, we didn't really see a strong reaction in our financial markets. We saw stocks did lose some ground, but they recovered very quickly. Yeah. And that was kind of what happened last week. And it led mortgage rates to really just, they went down, they went up, or they were actually up at the beginning of the week. Then they went down a little bit at the end of the week, but there wasn't a lot of movement. However, today we're seeing the door open for a lot more movement. And that was because there were new sanctions that were issued. And those sanctions are specifically, again, you guys could read up on that stuff in any of your favorite news sources, but the ones about what you'll see, the word SWIFT. And SWIFT is basically it's the tracking system for financial transactions. And because we've had some sanctions that involve that, it's much more pronounced today. And we're seeing that our markets are reacting accordingly, and stocks do not like this. They're freaking out about it. And then what happens is bonds improve, the 10-year treasury yield improves, and mortgage-backed securities improve. So I want to go deeper, Nathan, though. I know I'm doing a lot of talking, and I'm sorry, but I want to explain to everybody real quick. We talk about the financial markets, and the financial markets are your basis for mortgage rates and pricing. That is where it starts. It starts with something called mortgage-backed securities, and we can look at this fancy chart here, and we see the improvement on this chart. Are you still there? Oh, there you are.
Sorry.
All right,
There you
yes,
go.
that's okay. So we see the improvement on this chart where if you see this line go straight up right here, this is today, and this is actually good for mortgage rates. Up does not mean mortgage rates go up. What up means is that pricing is improving. The bond prices improve, and as the bond prices improve, it's more profitable. So
Hmm.
therefore, we see rates actually improve. However, what's really important to note and we've talked about this before, there's really two components to our mortgage pricing. There's this foundational component which we watch, and that's the markets, and then there's the lender margins. And mortgage companies, whether it's a big behemoth bank like Wells Fargo and they have a mortgage division, or whether it's a mortgage specific lender like Caliber Home Loans that's only a mortgage lender, whether it's lenders that are wholesale lenders that lend through broker channels with your mortgage broker, all of those lenders are profitable companies. And right now, we've seen rates really move very quickly. In our scheme of things, we've seen rates move up very quickly, and profits are disappearing. So these companies, they're faced with, what do we do in this environment? We've got staff that we still want to pay for. They don't want to cut staff too quickly. They've got loans that need to get done, but there's a lot less volume. And what we're seeing is the second half of the equation in mortgage rates is that lender margin component. How much is a lender
Right.
going to make? What are they going to add on to this base layer from the markets? And lender margins are getting a little bit thicker right now, meaning lenders are holding on to more profits, and we're not seeing rates necessarily improve as dramatically as we would based on when you look at these fancy charts. And that's not a bad thing. It's not greedy banks. It's not greedy anything. It's just business. But you have to
Hmm.
recognize that, because a lot of people right now may be hearing, well, rates will improve with the war and with this Ukraine Russia situation. We're not seeing a big improvement to rates when it gets to that consumer level. And it's important to recognize we may not see, a big improvement to rates. We'll see a little bit
Right.
of improvement, but not a big improvement. And you don't want to get caught in a situation that in this market where you don't take action because you're waiting for better down the road.
Right.
So that's kind of where I would leave everything and say is we're seeing so the likelihood this week is we could see a little bit of improvement to mortgage rates, but it will probably be a very small improvement, even though what we're seeing in the markets on the early side is a little bit more dramatic. Like this morning, if anyone sees this green 47, what that means is that mortgage bonds are selling for a higher price point than they were last week and on
Hmm.
Friday. And that's a good thing for your mortgage rates and pricing. But is
Hmm.
it good enough to see rates improve even an eighth of a point? Maybe not. So
Yeah.
that's kind of what I take. Nathan, what is your feedback on all this now?
I love that chart impact, and I would look at this and say, remember that just because something is happening overseas, and that is going to affect our stock and our exchange and our bond markets, it does not change the fact that we're facing inflation growth, and we want to stay out of stagflation as well. So the Fed Reserve is still going to make action. In fact, the MBA, their economists came out and said, hey, we don't think anything's going to change. We think the Fed's going to continue moving forward, affecting the bank rate. And we've talked about this before. The bank rate does not equal the mortgage rate, but it changes the cost of money borrowed between entities, which does change and have some impact. So that it is true looking historically when there's war, especially from a world perspective, and the stocks are affected. But we're at a different spot. We're very different. So I would anticipate, kind of like you said too, this isn't one like, oh, good, rates are going to fall. I'm just going to sit back and wait. This is one where like, hey, if you're ready to lock in, probably not a bad idea. But
Yeah.
we're still looking at really good rates. In fact, there is still cause for financial literacy reasoning to say that if you are sitting on lots of debt, and that debt is say over 5.5 to 6% in interest rate annually, you may want to look at refinancing and pulling out cash out of your property, especially with the raised equity positions, and looking at consolidating that debt and saving yourself a few points in interest plus putting it in your mortgage. We hear rising rates, and I think our brains just automatically go, rise is bad, fall is
Right.
good, right? You
Right.
just, even though they're marginally, you have to kind of statistically and strategically look at your interest rates in all your debt loads and that you're holding. And remember that in times of inflation, in times like this, debt is actually a fantastic tool to conserve value. when you're paying off debts that are locked in. But those are just
Yeah.
a couple thoughts. I don't know. What do you got?
I agree. And then, for anybody that wants to go with us down the rabbit hole, come on over and take a little journey with me. Because what I want to build on what you said, Nathan, was using the equity in your home and using that equity to pay off other debt. And a lot of people may be afraid to do that because they may be afraid that house prices are going to go down and that equity will disappear and they could end up upside down. And there's so many reasons why that's not going to happen anytime soon. Still huge demand for housing, and there's charts that we could share with y'all that show that there's more population than houses. We could look back at the 2008 housing crisis and the financial Great Recession that came after that and talk about how that really affected the growth of new housing for a decade. And we're way behind the eight ball and we're behind the curve as far as how many new houses are being built just to meet the current demand. We could also talk about it from an economic point of view of, hey, all of this money was recently put into the system. We had all of this financial, what did they call the stimulus, right? So they had all this financial stimulus money. We had unemployment money. We had all this money put into the system, and that money has to go somewhere. And a lot of it has found its way into housing, and it doesn't pull back out. This is where it's going to be. And we've seen wage inflation, which is good and supports housing. So for all these different reasons, with one more being that last year, this is the one that I think really just blows my mind. We hear about how low inventory is, and anybody that's house hunting right now, I know how hard it is, and I feel for you. Stick with it, stay with it, and here's why. You know that inventory is low, but the reason it's low is because of how strong demand is. It's not giving it a chance to replenish. In other words, I want you guys to think about if we had a bucket or if I had this can of seltzer here, and if I poke a big hole in the bottom, if I'm pouring from the top, but it's still pouring out the bottom, the can never have an opportunity to fill up until you have more going in the top than the demand that's coming out the bottom. If the hole in the bottom is bigger than the top, that's the problem. And where I'm going with all this is that we had more homes sold in 2021 than at any time in the last basically 15 years since 2006, which was almost the height of the market before the Great Recession. I mean, so think about the fact that it's the number of transactions. It's just, constantly happening. We can't get that inventory number up, but it's not because there's not homes coming onto the market, because they are. It's just that there's that strong demand. And as long as that demand remains strong, which with rates in the 4s, maybe even in the 5s, do you think demand will be strong at that? I do. What do you think?
I absolutely do. In fact, I was looking at another chart in a story. I think they were covering it in. So I just want to cite my sources, right? I think I was looking at Mortgage News Daily. The Realtors NAR, National Association of Realtors, expressed that new housing contracts are down, right, for the first time in a while. So what's nice about that is that it is causing a breath. I don't think it's a fall. I think it's a breath. It made everybody go, whoa, whoa, take a knee. Something's changing. Like, hold. And it's allowing the market to breathe for a second. And yeah, maybe we're seeing a slowdown on new contracts, but that doesn't mean a recession. That's not even a sign of failure, because the inventory out there has not grown exponentially in that time. Houses are still not sitting on the market for what we used to count by weeks. Now we count by days, right? When you said it was on the market for 6, you used to think it was 6 weeks. Now it's 6 days. You're going, there's still impact there. So that I don't think the rate is going to affect the forward progression as much as people may hope. I don't think we're looking at a recession yet. And when it comes to housing,
I agree. And again, along those lines, psychologically, everybody took a bit of a pause because we did see rates move up very quickly after the turn of the year. In January, rates jumped, and that was due to a lot of different expectations right after the holidays. And everybody was like, well, wait, I'm going to wait and see if things get better. And then things didn't get better. And we're going into the spring market, it's just going to take off again. It only slowed down a little, and it's going to take off again. And that's why everybody, it's a great time to buy a home, even with rates going up a little bit. It's a great time to consider refinancing, using your home as a financial instrument. Again, I'm not telling you for what they call arbitrage, where you should be pulling out your money from your home and investing it into cryptocurrency. But I am telling you that what Nathan said is a sound financial choice, which is taking higher leveraged debt, credit card debt, maybe even auto loans sometimes, things of that nature, and utilizing the equity in your home as a financial instrument and making a good refinance choice. So those things are still good, and you should definitely talk to a professional that can run the numbers for you and make your decisions. And then if Christopher would hear, he would also tell you to shop around. Make sure that you shop around to get a very good rate at that time. And, and I think when we see the volatility like we do now, shopping around can be a blessing and a curse. So when you shop around, you need to do it very quickly. In other words, what rate you see today could be different tomorrow. So shopping today to tomorrow, that's different. You want to shop at the same time, and then shopping around, though, why that could be a good thing. That's why it could be a bad thing, because it can be confusing if you are using different dates and sometimes even during the same day from the morning to the afternoon. But it could be a very good thing, because when I talked about 15 minutes ago, hey, margins are different. In other words, lenders have to decide what kind of profit do we need to be making in order to keep our company solvent and be making good decisions for the company. Well, that means that consumers could find a very significant difference in offers between lenders that maybe you don't normally see as big of a difference. And we're seeing those move very quickly. So, and that's why, but at the end of the day, I would always say too, again, just my personal input on it is that although these numbers are very important, you need to make sure you're working with someone reputable, whom you trust, that you have a good feeling. Trust your gut, not just whoever offered you the best rate online. That can very much be a bait and switch situation. That happens a lot. So, that make sure that you trust who you're working with, as Nathan would say, trust but verify.
Trust but verify, the VA slogan, right? I'm going to throw you a curveball. I'm going to throw one at you, because we talked about inventory, right? So out of the news, Friday? Yeah, I think they were talking about Friday or Thursday, OfferPad and Open Door, Zillow, right? Open Door actually comes out and they announce to their shareholding, like, they've actually had a bigger loss in 2021 than Zillow had. We were all familiar that Zillow had this massive loss because they were buying a bunch of homes and selling them and losing dollars. Same with Open Door. So Open Door is one of the OGs when it came to the iBuyer programs. They'd walk in, say, hey, we'll buy this, we'll buy this with cash. The interesting part was that their percentages were not nearly usual. They were somewhat competitive, but there were fees. Fees are associated with the process. And now they're reporting that they had a loss, and they're sitting on, in 44 different markets, they're sitting well over, a few, like 25,000 properties. What do you think it looks like when you have an iBuyer program like this sitting on property and not moving it right now in the constraint of the inventory issue that we're facing?
Well, there again, it just, contributes to what we said before about supply and demand. If they don't put that supply into the market, it makes that demand even more of a demand, if you will. So, if we do see a reduction in demand, we're seeing a reduction in supply as well. And I was away for the weekend, so I didn't read that article. One thing I'll point out is a lot of these iBuyer programs, and I think they did two things wrong. I think they mismanaged it big time, and manipulation. They were trying to manipulate the markets by buying a large quantity and pushing things up. So that kind of bit them, and I'm glad it did. But is that what they said, that they want to sit on the property, which that shows that they think that things are going to improve, that values?
No, not that they're sitting on it, just that they're not moving it currently. That it was the article does not say they want to sit on it. The article is just that they're not moving the property specifically. And the losses are great. I mean, my brain is that if I was looking to buy right now, I'd go in to figure out where all these properties are being held and get ready to make some aggressive offers if I was wanting to buy something in the future. I mean, at some point, they're going to go.
Yeah, if you could. I can't imagine, unless they're making a conscious decision to sit on them, there's nothing that I would think you can't see the market move right now. There's just too much of an appetite if it's priced even remotely appropriately for the market, that it's swooped up. There was a video that somebody took with their cell phone just showing a line around the block, cars. It looked like a barbecue, or a neighborhood barbecue, and it was people trying to come and look at an open house, and just how many people were interested in this house. And it wasn't anything special about the house except for the fact that it was within an affordable price point. So,
Right. Exactly.
Yeah.
I think we should still be bullish on our aspects and our interpretation of the real estate market. I think that it's worth kind of thinking that we're still have something there. I see people are worried, and people talk about, especially in VA, like, I'm not buying this market. It's too high, crash. You know what? Or we'll say this too. The other side of it is a lot of when you're active duty, you're told you got to go somewhere. You're PCSing, you're moving, right? You don't have a choice. So the choice you then make is, what will my future look like if I have to move and I'm going to have to do this? What do I do this? The awesome part about the VA loan is it allows for somebody to own a home, get orders, and move and go buy another one and turn that into rental. There's a lot of really cool, advantageous pieces of a VA loan. Also, in fact that you are in a VA loan and it's at a higher interest rate, say interest rates do come down around Christmas time and you had to buy because you moved. Well, as long as you've had 210 days from the date of that first payment, now you're eligible to EARL, an interest rate reduction refinance loan, right? With a VA, which is it's pretty simple process on your loan and low cost. Like, all right, let's move it down. And that was built by the VA for the veteran and the active duty member to really be taken care of. And
one of those few things, when you think of the government, you don't think of less red tape. And,
true.
That is one of the few things that actually make it a simpler process than a conventional refinance. The EARLs are a fantastic program.
Yeah. So anybody that's in the VA eligible loan and taking one now, just remember you have an instrument that actually is set up to actually help you in the future if and when those rates do make their dive or take a turn for the better in the future. So, well, man, I appreciate you greatly. Thank you. Any last parting words or screens or things you want to talk about?
No, again, actually, if you don't mind, pop the screen up for one more moment. We'll just one thing I want to point out. A few weeks ago, we talked about when rates jumped up, one of the things that caused the rate hike was that markets were expecting the Fed to make a larger Fed funds, which we talked about, that the Fed funds rate is that bank-to-bank rate that kind of is behind the scenes of all the other rates. The Fed does not set mortgage rates, but as that Fed funds rate moves, it moves the markets. And they were looking at doing, the expectation was rather that the Fed would need to make a very big move. And there were some Fed members, some Fed officials that in some of their comments and their speeches and their public comments, they were very, what's called hawkish, meaning they were, very proponent of these big moves and needing to see much larger increases. And just a couple of weeks ago, when we came out with inflation data, that inflation data showed that inflation, as we all know, and we're feeling it at the pump, at the store, everywhere else, we see this inflation. Well, it showed that, hey, the Fed maybe needed to make a big move, and it pushed mortgage rates up just a little bit, though. But as there was anticipation ahead of this move. Well, since then, and especially with this Ukraine and Russian situation, we've seen those expectations of a 50 basis point or a 0.5% rate hike in March. We've seen that drop back down to about 0.25%. What we haven't seen is we didn't see mortgage rates improve. Whereas when we first saw things go from the expectation of 0.25 to 0.5, mortgage rates got a little bit worse. Now we're going from 0.5 back to 0.25. So in theory, mortgage rates should get a little bit better, but they didn't. And there again, that's why that could be margins. It could be just some of the things that are going on behind the scenes. And it's why that even though you want to be informed, you have to be careful, because you can't always, even me doing this for decades, I can't tell you what's going to happen. We tell you the odds or the reasonings behind it. But now is a great time to go ahead and buy a home. If you lock in an interest rate, you're locking in a great rate. Don't look back. Don't second guess yourself. Don't try too hard to play the market. If you do want to work closely with a mortgage professional that can help you to keep on top of what's going on with rates and pricing, you may want to start the week just floating, as we call it, meaning you haven't locked in that interest rate yet, just to see where things go. But like today, we're probably going to see some pretty good rates and pricing from mortgage companies because of what's going on here in that bond market. We've already seen some lenders actually improve their pricing from early this morning as they saw these gains hold a little bit through the day. So don't be afraid to lock in an interest rate in this environment and be happy with it. If things get a little bit better, it's only going to be a little bit. You're not going to see somebody lock in at 4 1/8 or 4%, or maybe some of you may even be able to get just a hair below that. You're not going to see rates drop to 3.5. You don't have that fear of missing out, and don't be second guessing yourself in a transaction. And then as far as home prices, don't be afraid. You can turn the screen off now. Don't be afraid to make that move and buy a home, as Nathan and I were talking about. There's so many reasons why, now is still a good time to buy a home. I'm still investing in rental properties myself. You don't want to have to worry about that. Hey, this is something that's a bad time, because there's a lot of things that would have to go wrong to make this a bad time to own a home. And you'll be more worried about those than you would be on the price of the house.
Well said. I can't even add to that. That was really done. Really well done.
All right.
Well, appreciate you, man. Thank you for taking some time. If anybody's got questions, again, please leave some comments in here. We do monitor these well after the call, and we'll get alerted to them. So I appreciate you. And Hammer, I hope you have an amazing week.
You too, Nathan. Thanks for having me, and we'll chat next week.
Sounds good.
All right, my friend. Take care. Bye-bye.